A borrower waits for a bank's answer, knowing that a single decision could shape the next decade. The answer arrives without a meeting, a handshake, or a question about character. It arrives as a FICO score. One number can influence whether the loan is approved, how much it costs, and whether a plan for a home, a car, or a safer life moves forward. The number does not look like a judgment about a human being. It looks clean, exact, final. But behind it sits a record of borrowed money, paid bills, missed payments, and old accounts. The lender may never hear why a setback happened. The score turns a financial life into a result, and the result becomes a gate. Before 1989, lending often happened across a desk. A local bank manager reviewed a person's credit history, employment stability, reputation, and financial story. The manager might know the local employers, the rhythm of seasonal work, or the difference between a careless borrower and a reliable person hit by one bad year. That system was personal, but personal did not always mean fair. Two managers could study the same facts and reach different conclusions. One might trust a long work history, another might focus on a late payment. A borrower's chance could depend on who opened the file, what that person believed, and how well the borrower could explain the past. The pressure for change grew as banks handled more applications across larger markets. A method built on separate human judgments was slow and hard to compare. Lenders wanted decisions that could be repeated from one office to another, using the same broad rules for many applicants. The promise was simple: replace uncertain impressions with a steady measure of risk. That promise also fit the age. Computers could sort records faster than people could read them. A bank could process more applications without placing every decision in the hands of one manager. The shift was not only about speed, it changed what counted as evidence. A person's story began to matter less than the pattern stored in a file. The process began with credit history. Information about borrowing and repayment was gathered from reported accounts. The record could show how much debt a person carried, whether payments arrived on time, how long accounts had been open, and how often new credit was requested. An algorithm then processed those details and turned them into a FICO score. That score did not claim to know a person's heart. It estimated lending risk from past credit behavior. The lender could use the result beside income, debt, and other information when deciding whether to extend credit. A life made of separate events became a signal. The signal could be compared, ranked, and acted upon in seconds. The decisive public marker came in 1989, when the Fair Isaac Corporation introduced the FICO score to consumer lending. Fair Isaac had been building tools for credit decisions since the 1950s, so 1989 was not the birth of every credit algorithm. It was the moment the FICO name entered consumer lending as a clear, recognizable measure of credit risk. That date matters because it marks a change in authority. The bank manager did not vanish overnight, and human judgment did not disappear from every loan decision. But the center of gravity moved. Lending began to shift from a conversation about character toward an algorithmic reading of records, where the past could follow an applicant without needing to be retold. For the borrower waiting on an answer, something important disappeared. There might be no manager who knew the person's work history, understood a temporary loss of income, or recognized that one late payment came during a crisis. The file could contain the event, but not the reason. A score could measure the mark without hearing the explanation. That silence carried a particular weight. A human decision could be questioned, argued, or revisited. A score felt different. It seemed to come from somewhere distant, protected by math and locked inside a system the borrower could not see. When the answer was no, there was often no personal account of what had gone wrong, only a number standing between the applicant and the money. The appeal of FICO was powerful because objectivity sounded like protection. To call a process objective meant that it should rely on the same measured rules rather than mood, favoritism, or personal bias. One algorithmic method could bring more consistency, review more applicants, and help lenders make decisions at a scale no single manager could match. But a common rule is not the same as a complete view of a person. The system could make lending more orderly by narrowing the question. Instead of asking who seemed trustworthy, it asked what the recorded data suggested. That was efficient. It was measurable. And once the number became trusted, the old question of character began to hide inside a new one. What does the record say you are worth? The boundary of the FICO score was the boundary of the record. It could respond to payments reported, balances carried, accounts opened, and debts sent into collection. It could measure the history that reached a credit file. But it could not see whether a person kept promises when nobody was watching, or whether a missed payment came from carelessness, illness, or a lost job. That difference changed the meaning of evidence. A person might have steady work, careful habits, and a strong plan for the future, yet none of those facts counted unless they entered a lender's records in a usable form. The algorithm could not see future income. It could not read motives. It could not know about a family emergency that never became a reported debt. It saw behavior after it had been recorded, not the life that produced it. For people with little or no traditional credit history, the problem began before any payment was missed. The system had less evidence with which to estimate risk. An applicant might be asked for extra proof, offered less favorable terms, or turned away because the file was too thin to support a clear decision. The absence of data did not always mean bad behavior. Inside an automated process, it could still feel like a warning. That penalty reached people who paid in ways the credit system did not always capture. Rent, phone bills, insurance, and everyday purchases could show responsibility without building the same record as a loan or credit card. New workers, recent immigrants, young adults, and people who avoided borrowing could arrive at the bank with real financial lives but few recognizable entries. Their history existed. It simply lived outside the trail the score could follow. The decision no longer ended at the bank desk. As the historical transition spread through financial institutions, credit information became part of larger decisions about access and price. A score could enter the process for a mortgage, shape the interest rate attached to a loan, or influence how an insurer assessed risk where credit-based insurance scoring was permitted. The same reputation traveled. Housing made the stakes especially clear. A landlord or property manager could review credit information before handing over a lease, turning a private borrowing record into a condition for a home. Interest rates added another layer. Two people seeking similar amounts of money could face different costs because institutions placed them in different risk groups. The score had moved beyond lending. It had become a passport checked at several gates. That is how a number becomes a financial hierarchy. Institutions sort applicants by perceived risk, then attach different access, prices, deposits, or conditions to each category. The score does not need to make every decision alone. It only needs to organize the first cut. Once that ranking is built into software and policy, a lower position can cost more money, and paying more can make recovery harder. The result can last longer than the event that caused it. A temporary setback may leave a record that outlives the broken appliance, the short layoff, or the medical bill that started the crisis. The score turns time into a test. Months of steady repayment may repair the record slowly, while one serious interruption can close doors at the moment money is most needed. Over the following decades, this logic became part of the normal machinery of consumer finance. Automated systems could process more applications, but they also made financial reputation portable. A decision made from a credit file in one place could affect a move to another city, the cost of a car loan, or the ability to secure a home. The old character judgment had not vanished. It had been compressed into data and carried farther. Families felt that reach through ordinary choices. A parent with damaged credit might pay more for borrowing, leaving less for a child's education or a safer apartment. A young adult entering the system could inherit no score, but inherit the effects of a household unable to provide help. The number belonged to one person, yet its cost could spread across an entire family. For workers and communities, the change was quieter but just as real. When access to housing and credit depends on a recorded financial trail, people are pushed toward the products that create one, even when those products carry fees or risk. The score can reward participation in the system while making life harder for anyone who enters late, falls out, or cannot afford to borrow on its terms. In the end, the most revealing object was not the algorithm. It was the blank space where a life should have been. Beside a person's name, the FICO system could place a number built from recorded behavior, but it could not place a reason, a promise, or a future.